The government may help boost investor confidence and bolster growth potential, but muted private investment and the banking sector risks will remain a constraint on India's sovereign rating, warns Moody's Investor Service. This comes just a day ahead of the government's meeting with the agency to pitch for a ratings upgrade. Moody's warning may well be a signal that an upgrade may or may not be in the offing just yet. CNBC TV 18's Ritu Singh is here with more.
The Finance Ministry is in a huddle, getting together the reforms record of the Modi government to pitch for an upgrade in India's sovereign rating. But a day ahead of its meeting with the Finance Ministry, Moody's Investor Service has raised some red flags on India's macroeconomic outlook. The ratings agency says credit implications of the reforms undertaken by the government will only materialize in the medium term. For now, structural hurdles will continue to constrain private sector investment and growth. So will there be a chance for a ratings upgrade anytime soon?
We think that the government debt will remain relatively elevated compared to other sovereigns rated at Baa3, partly because nominal GDP growth is moderate, and that kind of hampers some of the fiscal consolidation.
Moody's warned that the government had already hit 74% of the budgetary target in the first 4 months, and there could be significant spending cuts in the latter half of this fiscal. Also, private investment remains weak due to high debt on the corporate books. Moody's also cautions that the banking sector will remain a drag on India's sovereign ratings over the medium term. So while bad assets recognition was the first step in strengthening banks, they may still need higher equity infusion from the government than initially budgeted. This will further add to the government's challenge in meeting its fiscal target.
We think the fiscal deficit target is ambitious. It's a tighter deficit than last year in an environment that is not necessarily so favorable, with moderate nominal GDP growth and some constraints, some commitments on spending, in particular with the pay commission and some commitments on infrastructure. We think that the target is likely to be broadly met, potentially with some late spending cuts later in the year.
The positives include the cementing of the monetary policy framework, which will help maintain inflation at moderate levels. This will be a credit positive, according to Moody's. So will be the implementation of the goods and services tax, which will enhance revenue collection for the government over time. In addition, easier FDI norms, ease of doing business, and introduction of the bankruptcy law will further bolster India's growth potential. But even then, warns Moody's, these reforms will at best ease than remove hurdles to robust growth. In Mumbai, Ritu Singh.